talk about something that drives traders absolutely crazy. This idea that your broker is personally hunting your stop loss. Is there any truth to it, or is there something much bigger going on behind the scenes? Let's get into it.
You know the feeling, right? I mean, you've definitely been there. You find the perfect setup, you place your stop loss in what feels like a totally safe, logical spot, and then bam! The price comes down, takes you out to the exact tick, and then immediately reverses and flies in the direction you predicted. It feels like a personal attack, like the market has a vendetta against you. But what if it's not personal at all?
And look, these are the classic moments that make you want to throw your monitor out the window. That perfect spike that just nicks your stop. The breakout that looks so promising, but the second you get in, it just dies. Or those crazy news events with a giant wick that seems designed specifically to liquidate your position. It's easy to think the game is rigged against you personally.
So here's the fundamental shift in thinking we need to make. The common belief, the easy story, is that your broker's the villain, actively hunting your stop for their own gain. But the market reality? It's way less personal and way more, well, mechanical. Price isn't drawn to you. It's drawn to huge pools of orders. It's drawn to something called liquidity.
And this is the part that can be a little tough to swallow at first, but it's so important. The hard truth is, the market has no idea who you are, it doesn't know your name, it doesn't know your strategy, and frankly, it doesn't care. To the market, you're just a tiny drop in a massive ocean of orders.
And hey, don't just take my word for it. This is a core idea in finance. Theories like the efficient market hypothesis basically say the same thing. The market is so vast, with so many participants, that the order from any single retail trader like you or me is pretty much insignificant. It's just not big enough to be a specific target.
So if the market isn't hunting you, what is it hunting? It's hunting liquidity. So what is that? Well, in its simplest terms, liquidity is just how easy it is to buy or sell something. If there are tons of buyers and sellers at a certain price, liquidity is high. You can get in and out of a trade super easily. Honestly, the best way to think about it is like this. Liquidity is the fuel for the market's engine. And the biggest vehicles on the road, the giant hedge funds, the investment banks, they need a massive amount of this fuel. They can't just click a button and buy $1 billion worth of something without sending the price to the moon. To fill their huge orders, they need an equal number of people on the other side of the trade. So where on earth do they find all this fuel? Well, they find it from us, from our stop-loss orders. Just think about it. If thousands and thousands of traders all put their stop-loss orders in the exact same obvious area, you create this giant, concentrated pool of guaranteed orders. And that is the liquidity that big institutions need to fill their positions without causing a fuss.
And these areas have a name. They're called liquidity pools. They are these concentrated zones on the chart that are just jam-packed with retail stop orders. Smart money, the institutional players, they know exactly where these pools form because, well, they're always in the same obvious places. And here's where you'll find them every single time. Where does every trading book on the planet tell you to put your stops? Right above an obvious high, right below an obvious low, or right around those crystal-clear support and resistance levels. These are the textbook spots, and they become massive magnets for price.
Okay, let's just walk through a classic example. Let's say the market creates this super clean, obvious resistance level, what some people call equal highs. What happens? Thousands of retail traders see this, they go short, and they all place their stop losses in the same place, just a little bit above those highs. And just like that, a giant liquidity pool has been created.
And then it begins. What feels like a stop hunt is actually what we call a liquidity sweep. Price is intentionally and very purposefully driven just above that resistance level. This triggers a cascade of all those stop-loss orders. All the people who were short are now forced to buy their positions back to get out of the trade. And here's the magic. Now that all of that retail buying has been triggered, the institutions have the perfect opportunity. They can now sell their massive short positions into all that buying pressure without moving the price against themselves. They've captured the liquidity, filled their orders, and now the real intended move to the downside can begin. That's why you see that vicious reversal right after you're stopped out.
So let's just look at this one more time side by side. What it feels like is personal. The market hunted my stop loss. But what's actually happening is completely impersonal and mechanical. The market moved to a predictable zone of orders so that large players could do business.
So if you remember one thing from this whole explainer, let it be this. Your stop loss wasn't hunted because it belonged to you. It was triggered because you, along with thousands of other traders, put it in the same obvious, predictable place. You were just part of the herd, and the market hunts the herd. Okay, so how can we actually use this to our advantage? It's all about a simple 3-step framework. First, your new job is to identify the obvious. Find those liquidity pools on the chart. Second, you need patience. Instead of trading into those zones, you're going to wait for the sweep. Wait for price to take out that liquidity. And third, you trade the reaction. You look for your entry after the liquidity has been taken, and the market shows you its real direction.
This quote right here really just wraps it all up perfectly. The market isn't hunting you, it's hunting liquidity. The pros aren't evil. They just know where we've all been taught to place our orders, and they use that to their advantage.
So really, the big takeaway here is that you need to completely shift your perspective. Stop thinking like a typical retail trader. Instead, start looking at your charts and asking one simple question. Where is the liquidity? That one question will change the way you see the market forever.
Now, understanding this concept is really just the beginning. It's the first step down a much deeper rabbit hole of how institutional order flow actually works. So if this explainer kind of blew your mind and you want to learn more about the real mechanics behind the market, make sure you subscribe. We've got a lot more to cover.